Today, we're doing a complete breakdown of ASC 606. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine a tech company recognizing a $10 million software contract as revenue before delivering a single line of code. ASC 606 revolutionized this by establishing a uniform methodology for revenue recognition. Now, whether you sell software, services, or widgets, you'll understand how to recognize revenue consistently and transparently. ASC 606 emerged to eliminate the chaos and discrepancies in how companies recognized revenue. Prior to its introduction in 2018, diverse industries followed varied practices, which often resulted in financial statements that were neither comparable nor reliable. Imagine two companies, one in tech and another in construction, recognizing revenue from a similar contract in completely different ways. Now, with ASC 606, there's an established, transparent process ensuring everyone plays by the same rules. ASC 606 is not just for large corporations, it impacts every company engaging in contracts with customers. Effective December 2017 for public entities and a year later for private ones, it mandates recognizing revenue when the control of goods or services changes hands. This shift from recognizing revenue on delivery to recognizing it when control transfers ensures more accurate financial reporting. Whether you're a tech giant or a local construction firm, if you have customer contracts, ASC 606 is your guide. The 5-step revenue model is the backbone of ASC 606, crucial for understanding how to recognize revenue correctly. First, identify customer contracts to ensure they're legitimate. Next, determine distinct performance obligations, like delivering software and providing support. Establish the transaction price, considering any potential discounts. Allocate this price to each obligation, ensuring clarity on what each part of the contract is worth. Finally, recognize revenue once obligations are satisfied, reflecting true economic activity. This method is essential knowledge for interviews and financial analysis, ensuring precise revenue reporting across industries. Understanding scope is crucial. A classic mistake is overlooking that leases don't fall under this standard. Misplacing these exclusions can lead to errors in revenue recognition. This is a common interview trap, and avoiding it can set you apart. Let's see what ASC 606 covers and the pitfalls to watch out for. ASC 606 applies to contracts involving sale of goods, provision of services, and licensing agreements. When a company sells software as a service, this falls under ASC 606's scope. The standard ensures revenue is recognized accurately when promised goods or services are transferred. Understanding these inclusions helps in correctly applying the revenue recognition principles. ASC 606 explicitly excludes leases, insurance contracts, and financial instruments. These exclusions are traps for the unwary. Many mistakenly try to apply ASC 606 to a lease, only to find it doesn't fit. Knowing these boundaries prevents missteps in revenue recognition. If you're handling financial instruments, know they require distinct accounting treatment outside of ASC 606. Contracts are foundational in ASC 606. They create enforceable rights and obligations between two or more parties. For instance, if a tech company signs a contract to deliver software products to a client, this agreement is legally binding, ensuring both sides meet their commitments. Contracts need mutual approval and commercial substance to be valid under this standard. Performance obligations are promises made in contracts to transfer distinct goods or services. Imagine a car manufacturer agreeing to sell a vehicle and provide annual servicing. Each is a separate obligation. ASC 606 requires these to be clearly identifiable in the contract. Once fulfilled, revenue is recognized, aligning financial reporting with actual performance. Scope edge cases often trip up candidates. Does ASC 606 apply to a gift card sale? Yes, as it represents a promise for future goods or services. Software updates, commonly considered as service contracts, also fall under this standard. Franchise fees might combine licensing and service elements, while memberships offer access rights, making it crucial to differentiate components for accurate revenue recognition. Companies struggled to recognize revenue consistently, causing financial statement discrepancies. The five-step model under ASC 606 aligns revenue with actual performance, ensuring transparency and precision. Imagine a company with a complex multi-year contract. How should they recognize revenue? This model provides a clear roadmap, turning ambiguity into accuracy. The five-step revenue model is the backbone for recognizing revenue with precision and consistency. It ensures each dollar aligns with what's delivered. We'll explore this through Meridian Corporation's $10 million SaaS contract with Acme Incorporated, involving an $8 million software license and $2 million for implementation. Each step builds on the last to ensure a complete, accurate reflection of the contract's value. Meridian Corporation's journey begins with identifying their $10 million contract with Acme Incorporated as enforceable under ASC 606. This step ensures the contract is legally binding, with clear rights and obligations. A frequent pitfall is neglecting termination clauses, which might affect enforceability. The outcome here is a confirmed enforceable contract, setting the stage for identifying performance obligations in the next step. Next, Meridian Corporation must identify distinct performance obligations in their contract. The $8 million software license and $2 million for implementation services are treated separately, reflecting distinct obligations. Many missteps occur by not recognizing integrated services as distinct. Here, recognizing two separate obligations allows for a clear allocation of transaction price, preparing us for the next crucial step, determining the transaction price. With performance obligations clear, Meridian Corporation calculates the transaction price of $10 million, encompassing the $8 million software and $2 million implementation. A frequent error is ignoring variable considerations like potential discounts. ASC 606 requires including all expected considerations, ensuring the transaction price reflects the contract's full economic reality. This clarity is vital as we allocate the price to specific obligations in the next step. Now, Meridian Corporation allocates $10 million across its two obligations. The $8 million aligns with the software license. $2 million covers implementation. This allocation often occurs by ignoring standalone selling prices, skewing revenue recognition. ASC 606 mandates allocation based on relative standalone prices, ensuring each component of the contract reflects fair value. This sets the stage for recognizing revenue as obligations are fulfilled. Finally, Meridian Corporation recognizes $8 million upon transferring the software to Acme Incorporated, with $2 million recognized as implementation milestones are met. A typical blunder is premature revenue recognition before control shifts. ASC 606 stipulates recognizing revenue only as performance obligations are satisfied and control transfers. Thus, the recognized revenue mirrors the actual delivery and completion, closing the loop on our running example. Imagine your balance sheet reflecting a $10 million asset that should be $7 million. The measurement method you choose under ASC 606 has real consequences. Here, we explore the measurement choices available and the critical disclosures you must provide to ensure financial transparency. Initial recognition under ASC 606 focuses on control transfer. Revenue is recognized at this point, often aligning with delivery. The transaction price, sometimes involving variable consideration, must be carefully assessed. If your contract has a significant financing component, you must adjust the revenue. Consideration constraints can impact your estimates, demanding constant reassessment. Subsequent measurement under ASC 606 requires vigilance. Revenue estimates may need revision if conditions shift materially. Changes in transaction price necessitate careful recalibration, particularly affecting distinct performance obligations. Variable consideration isn't a set-and-forget scenario. It demands continuous evaluation to ensure revenue aligns with expectations. Contract modifications, by altering enforceable rights, can also prompt remeasurement, impacting your financial statements. Presenting ASC 606 revenue starts with clear categorization on the income statement. Contract assets and liabilities find their place on the balance sheet, showcasing your obligations and customer payments. The notes require transparency about significant judgments and shifts in contract estimates. Classification rules determine whether items are current or non-current, guided by when you expect fulfillment. Ensuring clarity in these presentations enhances stakeholder trust. Disclosures are a cornerstone of ASC 606 compliance. Revenue disaggregation by category helps stakeholders understand different streams. Contract balances provide a snapshot of obligations, showing changes over time. Clearly outlining performance obligations, including timing, offers a window into your revenue recognition approach. Significant judgments must be disclosed to illuminate the reasoning behind financial figures, offering transparency and trust to users of financial statements. Consider a CFO overseeing a $500,000 contract with variable consideration tied to performance metrics. Revenue is realized at milestone achievements, demanding ongoing assessment of criteria. With payments stretching beyond a year, financing component adjustments are essential. When contract modifications arise, the CFO must remeasure and reallocate revenue among obligations. This dynamic scenario showcases how ASC 606's principles come to life in real-world financial management. Meridian Corporation, a global manufacturing company, enters a $1.2 million contract to deliver industrial machinery over 12 months. Discover how ASC 606 impacts every accounting decision, from initial recognition to financial statement presentation. Under ASC 606, revenue isn't recognized upfront. Instead, Meridian Corporation records a contract asset, reflecting the right to consideration and unearned revenue. This approach defers revenue recognition until the machinery is delivered, ensuring financial statements accurately portray the company's obligations and rights. As machinery is delivered, ASC 606 requires Meridian Corporation to recognize revenue proportionate to the performance obligation fulfilled. This month, $100,000 shifts from unearned revenue to recognized revenue, which accurately reflects the company's earnings in its financial statements. Each subsequent delivery allows for revenue recognition, aligning with ASC 606's revenue recognition principle as obligations are met. This method ensures that revenue on the income statement corresponds directly with the completion of performance obligations by Meridian Corporation. By mid-year, $600,000 has moved from unearned to recognized revenue. ASC 606 ensures that the financial statements provide a clear view of the revenue earned and remaining obligations, maintaining transparency for stakeholders. Year-end adjustments ensure accuracy in financial reporting. ASC 606 necessitates reevaluation of undelivered obligations. Meridian Corporation adjusts its revenue recognition, reinforcing the reliability of its financial disclosures and providing clarity on future obligations. Completing the final delivery satisfies the remaining performance obligation. ASC 606 requires full revenue recognition now that the contract is complete. This final entry marks the transition of all unearned revenue into realized revenue, accurately reflecting Meridian's operational success. Finalizing the contract cycle involves closing all related accounts. This process ensures that Meridian Corporation's financial statements accurately depict the completed revenue cycle, adhering to ASC 606 standards, and provides a clear financial position to stakeholders. Every Big Four and investment bank interview on ASC 606 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. This is where the standard gets specific. What is ASC 606, and why does it exist? The accounting logic behind this. Define a performance obligation. What interviewers focus on here? Recording revenue for variable consideration. Here is what makes this important. Recognizing revenue over time. The key insight here: difference under Indian accounting standard versus international financial reporting standards. What every finance professional needs to know: scenario, multiple performance obligations. Here is the core idea: scope trap, contract modification. This is where the standard gets specific: advanced disclosure requirements. The accounting logic behind this trick: recognizing revenue at the right time. What interviewers focus on here: comparison, ASC 606 versus U.S. generally accepted accounting principles. Let's break down the basics of ASC 606. Its objective is to standardize revenue recognition across industries. It applies broadly, with key exclusions like leases and insurance. Contracts create enforceable obligations, and each performance obligation must be distinct. The transaction price is what the company expects to receive. Revenue recognition aligns with fulfilling these obligations, ensuring clarity and consistency in financial reporting. The five-step revenue model of ASC 606 begins by identifying contracts and performance obligations. Companies must estimate the transaction price and allocate it to each obligation. Revenue is recognized when control transfers to the customer. This model ensures revenue is measured accurately, reflecting the actual economic activity. Understanding this process helps in consistently applying the standard across various contracts and industries. For interviews, focus on key aspects of ASC 606. Understanding variable consideration requires selecting the right estimation method. Contract modifications can lead to new contracts if distinct goods are added. Identify if the entity acts as principal or agent based on control. Disclosures are vital, covering contract revenue and performance obligations. While ASC 606 and International Financial Reporting Standards 15 are similar, disclosure nuances vary. Common pitfalls include misclassifying obligations and price allocations. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.